Hello, friends. Are you worried about what happened to the markets on Friday by closing? The Nifty and the Bank Nifty simply slumped under the weight of its own values. Are you remembering how I keep reminding you on my social media posts that on Fridays you must watch the last 75 minutes of trade very, very keenly, and now you know why. If you are worried about what to do in the coming week, this video will attempt to answer all your questions. I'm Vijay Bambwani. I trade these markets since 1986, and through my videos, I'm attempting to help my friends and followers make more money, make informed decisions, and basically raise the probability of success in their trading. Let's jump right in and see what happened. On your screen now, what you're seeing is that the Nifty fell mildly, whereas the Bank Nifty relatively outperformed the Nifty 50 by gaining a tad. Gold and silver fell, not surprisingly, because the US dollar index rose to its highest level after December 2002. Now we are approaching 19-year highs. Crude oil jumped again due to a prolonged war. Natural gas also jumped because the Russians cut off supplies to Poland for non-payment in rubles. The USD INR also rose 0.29%, thereby weakening the rupee to that extent. And a rising dollar is expected to pressurize emerging markets, including India, for reasons I have explained to you in my earlier videos, that they tend to be import dependent. They have a lot of dollar denominated debt, and repayment of dollar debt becomes more expensive whenever the dollar becomes stronger. The 10-year benchmark bond yield eased marginally by 2 basis points to 7.15%, and the NSE market cap continued to fall and logged more than 1% in losses. The MWPL fell to 20.46%, which is routine for an expiry week. Now, all the three overseas indices fell, and they fell pretty noticeably. This is what the concern is, and that might weigh on our domestic markets. Let's take a look at the chart of the S&P 500. It's a very broad-based index, and this is a weekly chart, do remember. So each candle represents a full week of trading history. Note how since the last 4 continuous weeks, consecutive weeks, the S&P 500 has fallen. It is now trading below its 25 and 50-day moving averages, which means even buy and hold investors who would have gone long 6 months ago are now underwater. Let's see what's the Nasdaq doing. I've constantly reminded you in my previous videos that the Nasdaq has exhibited what is known as a death cross. The chart on your screen reminds you of what I've been telling you of the Nasdaq. Now to come to the latest weekly chart of the Nasdaq, you can see that it's also fallen for 4 consecutive weeks, and it's now trading at its lowest after May 2021. That's an 11-month low. Not only that, the 25-week exponential moving average is just about going to cut the 50-week exponential moving average downwards. That's not really very good. And our information technology or software company, the tech sector, stocks might just come under pressure if the Nasdaq continues to fall like this. What's happening to the Dow? The old economy Dow Jones Industrial Average is similarly coming down with the indices coming, the moving averages are tapering downwards, and the Dow Jones has actually fallen for 5 consecutive weeks, with each progressive candle getting larger and larger on declines, which means the downward momentum actually escalated. This is not something that should have happened, and I would suggest my viewers and friends watch the 32,000 levels keenly on the Dow Jones Industrial Average on a sustained closing basis. Should the Dow start closing sustainably below 32,000 levels, I think you need to put some stop losses on your long positions. Friends, I now come to the MWPL chart, the daily chart. What you can see is a steep precipitous decline, which is routine on expiry. And what I have been telling you is that the MWPL is peaking out far lower than the 30% levels. Gone are the days when 32 to 34% used to be seen up to October, November. So risk appetite from the two Marshmallow traders has contracted significantly. What is the Marshmallow theory? You will see in this video, the thumbnail of which you can see on your screen. The hyperlinks to this video are in the pinned comments below this video, in the description below this video, and it will also appear in the end screen of this video. Let's now go to the weekly chart of the MWPL, and you can see that MWPL similarly has kind of peaked out between 28 and 29%, and like I said, gone are the days of 30%. Overnight traders or two Marshmallow traders are clearly showing signs of lower risk appetite. Let's now move to the stock and index futures turnover on a daily chart basis for 20 consecutive days. What you are seeing is that the index futures have seen higher volumes, whereas individual stock futures volumes have simply dropped off a cliff after peaking out on Wednesday and Thursday. This is pretty routine in an expiry week. Do remember, when you roll over your positions from March to April or April to May, there is a duality in turnover. So one turnover is in the previous month and the one in the following month. So on expiry day, after expiry day, turnover does tend to fall, but week on week, it is the indices which have logged higher turnover. What does it tell you? That the one Marshmallow guys, do check out the Marshmallow theory like I told you in the earlier video. The one Marshmallow guys are also showing defensive approach because indices are less volatile compared to individual stocks, and they are focusing on indices rather than stock futures. The same volume chart of index and stock futures seen on a weekly compression basis. Now this is 20 weeks data, 4.5 months. Stock futures turnover has fallen, and index futures turnover continues to rise for the second consecutive week. So this defensive play out there. Now let's check the risk appetite in terms of basis. Now basis is nothing but the premium enjoyed by the futures over spot. And what you can see is that the Bank Nifty has shown a mildly higher basis, whereas the Nifty 50 has shown a significantly higher increase in basis. Do remember that this is the May futures basis, and the previous week's figure is of the April futures basis. So in spite of the fact that the traders now have almost 4 full weeks to play around with, the premium that they are paying on the indices is nothing serious to write home about. What does it tell me? It tells me that there is caution in the undertone. I don't think people are writing out checks, figuratively speaking, writing out checks with a large-hearted risk-taking approach. Let's now see the basis on a weekly compression chart. What you can see is that the Nifty basis indicated by a blue line has risen, but still way below its peak made a month ago. Whereas the Bank Nifty basis is basically far lower than its peak made 4 weeks ago. So what I would watch is the basis on a day-to-day outlook. Don't worry about where to find it. You will get it on my social media accounts. I put up all this data late evening or very, very early morning next day on my social media accounts. Do connect with me. My contact coordinates will come at the end of this video, and we can help each other become better traders and read the message of the markets. Coming to another indicator, which is my favored indicator, the advanced decline ratio. This calculates the number of shares rising versus the number of shares falling. And a very simple but highly accurate metric, the advanced decline ratio is showing that only on one trading session out of 5 did the advanced decline ratio go above 1. And not only that, it's been trading close to the lower end of the 20-day range, which means the one Marshmallow traders, the intraday traders, are showing a complete lack of risk appetite. Not a good sign. Let's see the weekly chart of the advanced decline ratio going over 4.5 months. What you can see is a confirmation of what the daily chart said. 2 abnormal peaks above levels of 5, but then thereafter a very, very sharp and precipitous distribution has occurred in the last 2.5 months. So knowledgeable traders have been basically offloading quite a lot of positions, and for the second consecutive week, the advanced decline ratio remained below 1. That's not exactly a very great sign. Let's now go to the impetus chart, an indicator which you've tried for more than 1 year. I swear by it, you will also, if you've been following it long enough. So now the impetus chart shows the Nifty and the Bank Nifty impetus falling uniformly. And as I've explained to you in my earlier videos, this is not necessarily a good sign. You could construe, or rather misconstrue, that the indices have fallen. And if the impetus is falling, which means the fall has been accompanied by lower velocity. I've also told you that the other aspect of the impetus is it is indicating that these indices are now like compressed springs. At some point in time, the spring, when it's let go, it'll simply expand and jump up in the air, which means extremely high volatility, a shift in direction possibly, or even if it continues in the current direction, which is downwards, there will be a huge acceleration in the velocity. So I'm shifting you to the weekly chart, and you can see how the impetus has been falling now for over 2 consecutive months. It's seeking lower and lower levels, which means the market is now getting compressed like a spring. Get ready for very sharp moves in either direction with very high volatility. That's something that I've been warning my friends on my social media account very, very often. Please trade light and take extreme caution. Now for our latest indicator that I have shared with you off late, the LWTD indicator. If you remember, in my last week's video, I told you based on the weekly readings of LWTD that the LWTD was above 0, whereas the index was below 0, which means Friday's closing will be significantly higher than the intra-week low. That was confirmed by the market, and full marks to the LWTD indicator. So let's now see where the LWTD indicator on a daily time compression is. I'm giving you a look back data of 20 days. What we are seeing is that the index spot gain loss percentage reading indicated by a blue line is now obviously below 0 because the Nifty fell on Friday. The LWTD remained below 0, but it's attempted to go a little higher, which means at opening levels on Monday, you could see a decline, but during the day, bulls might just attempt to offer some support. I'm not saying that the day necessarily has to close in green, not that. But the markets might resist a fall, which means you're not looking at an outright kind of a slam dunk, hopeless kind of a fall. Now for the LWTD on the weekly chart on a 20-week time compression basis. Look at how the LWTD indicated by the red line has collapsed. I told you last week that the markets will close off its Friday low because the LWTD was rising, even though the Nifty was falling. But now the LWTD has fallen, which means that this market on a week-on-week basis, the earlier chart was daily, so the outlook was only for Monday. But this chart is for the entire week. Unless this reading improves in the middle of the week, I would say that the market might, has a very high probability of encountering sell on rallies kind of a pressure. Overhead supply coming in from traders who are stuck with long positions initiated at higher levels are now eager to get out at break-even levels. Friends, I now take you to the footprint of the four types of market participants. I start with the FIIs. As you can see, week-on-week basis, their individual stock futures and index futures open interest has come down uniformly. They are showing lesser risk appetite. Moving to the domestic investment institutions, you're seeing their short positions in both individual stocks and index futures is rising. So they are pressing more and more shorts, which means their outlook on both the indices and stock futures is negative. Let's now go to the prop traders. These are brokers' own trades. They are next best after insiders because they know who's buying and selling. These guys, the prop traders, seem to be, relatively speaking, a little optimistic because they've increased their long positions in individual stock futures as well as in the index futures, where last week they were net short, now they are net long. Now, part of this can be also attributed to the expiry. Ahead of expiry, maybe they just reduced their exposure a little bit, and after expiry, they've come and reinitiated their position. So let's wait for another 3-4 days and see where this metric is going to. Now, for the retail segment. Now, these guys have been doing all the buying and supporting of the market. They've been doing all the heavy lifting. And where individual stock futures are concerned, they've ramped up their net long positions on a week-on-week basis. Here again, expiry could be one reason why they reduced their positions a little bit. And where index futures are concerned, they've reduced their longs marginally. So they seem to be taking the contrarian view as compared to the broader markets. They are showing higher risk appetite by initiating trades in the individual stock futures rather than the low volatility indices. Friends, the indicator segment done. I now take you to the bond market yields. This is a very critical week for interest rate sensitives and for people like me who monitor fixed income markets. You see, the Fed, we are now getting close to the point where the Fed will take a decision of about whether they need to or they are going to raise coupon rates or interest rates. If at all rates rise, it will have repercussions and implications for financial markets, whether it is currencies, commodities, equities, or bond markets, all will feel the ripple effect. Just like you throw a stone in the water, the ripples move outside. The Fed's action might have a ripple effect. So, in anticipation of the US Fed, as also in anticipation of higher inflation prints, what you are seeing is that bond yields have basically firmed up marginally. They never went below 7%, which is why I keep telling my friends on social media, please continue to ladder your investments in the bond market through the RBI Retail Direct platform. Trading is free. You don't need any broker. You don't need to go through any bank. You are your own boss and nobody has any vested interest in buying and selling to you. It's commission free and 100% of your money is guaranteed by the central government of India. And the yields are far better than a fixed deposit where your bank is guaranteeing only 5 lakh rupees of your money and giving you maybe 5.5% to 6% ballpark. So I think you should continue to ladder, and yes, the GS 2035 remains my choice of the sovereign bond. GS 2035 means the bond is maturing in the year 2035. Fairly liquid, very well traded on the RBI Retail Direct platform. Please feel free to add on to your positions because the yields are now getting better, and do keep staggering your investments, which is laddering in bits and pieces rather than committing all your money at one go. Friends, I now come to the US dollar index. Now, this is another factor which to me is a red flag. Why a red flag? Because India is a net importer. And any country which is a net importer as well as is nursing some amount of foreign exchange loans we'll find that imports become more expensive, so imported inflation occurs. Secondly, as the 1997 Southeast Asian currency crisis has taught me as a trader, when a country's currency weakens against the dollar and it has dollar denominated loans, say for example, the dollar is 65 when you take a dollar loan and the dollar goes to 70 after you've taken the loan. So when you got the dollar into the country, you got 65 rupees per dollar. Now, when you want to buy dollars to repay that loan, you'll have to spend 70 rupees to buy $1. And find out companies who have the most amount of dollar denominated foreign exchange loans, you will find that their share price is likely to be impacted, which is why do not underestimate either the bond market or the US dollar index. Just because you're an equity trader does not mean you shut your eye and say, I'm going to look at nothing else. Please do not run the risk of having tunnel vision. Tunnel vision is not looking sideways at all, just looking like a horse straight ahead. You can't be a cart horse, right? Have a 360-degree worldview and look at the entire world around you. Whatever impacts the price of anything that you buy or sell needs to be monitored by you, otherwise you will suffer a loss. So now, to cut the long story short, let's see the US dollar index. It rose on 4 out of 5 trading sessions and it gained 2.07%. It's now at its highest intra-week after December 2002. Now, this, like I told you, is likely to pressure emerging markets, and the daily chart on your screen shows that the dollar index has run far away off its 25-day exponential moving average, which is a proxy for a month-long holding on cost of an average bull. So maybe there might be some profit taking and declines might occur, but the short-term outlook remains extremely positive. Do note how the last candle, a big prominent red bearish candle, is a bearish engulfing pattern where the candle's range has engulfed the previous candle's bullish range, and unless Thursday's candle's high is overcome, I would say in the absolute near term, you might just see a little bit of profit taking on the US dollar index. Taking you to the weekly chart now, you can see that it's a large bullish power candle. It's quite simply the largest candle in recent times. Although it has a higher wick or a shadow on the top, because do remember, Friday was a bearish day. But nevertheless, the body of this candle remains big and strong, which means the bulls are in control. The red line is the 25-week exponential moving average, which indicates a 6-month-long holding on cost of an average bull, and the price is far above that. So the medium-term outlook remains positive for now. Barring short-term profit taking, I don't see much to worry about where the bulls are concerned. Last week, I advocated a range between 102.5 to 99.75, and I do admit the US dollar index exceeded our resistance level because there was so much strength in it underlying. So in the coming week, I expect a range between 104.65 on the upside and 101.80. Why am I giving you a wider range? Am I trying to cover my backside? No, not at all. This is not a cover your ass exercise. This is because the base effect of the volatility, statistically speaking, if you've designed any statistical models, you will know that the base effect is a very important metric, and the base effect has now expanded. So the prices are going to thrash about a little more. So 104.65 and 101.80 in the coming week is where I see the US dollar index. Friends, I now come to the Bank Nifty, which relatively outperformed the Nifty 50 by gaining 0.12% on a week-on-week basis. Just about managed to close with mild gains. And it rose on 3 out of 5 trading sessions, which is why it managed to keep its head above water. Now, as you can see on the daily chart on your screen, the index has been trading throughout the week below its 25-day exponential moving average, which itself is sloping downwards. Now, this 25-day exponential moving average might seem like a very simplistic tool to you, but it's a 1-month-long holding on cost of an average trader, which means that the price is continuing to remain under pressure, and buy and hold and buy and carry forward long position holders are now sweating under their collars. Now, this leads to the concept of overhead supply. Whenever the price comes to a break-even point, these short-term weak hands will try to attempt to exit. That means they will provide supply at overhead levels when they are breaking even. That is something that you will have to grapple with in the week ahead. Going to the weekly chart on your screen, we are seeing that an inverted hammer-like candle, because the lower wick is fairly prominent here, although not very big, but it is an inverted hammer. The price has touched the 25-week exponential moving average, which is a proxy for a 6-month long holding on cost, and fallen from there, which means that at higher levels, medium-term buy and rollover long position holders are attempting to exit. Not a very great sign. So are the bulls ready to throw in the towel? Are they going to lose their patience? I think we need to watch some pretty round numbers. Like say, for example, 34,000 to 33,500 odd levels. If the market was to continuously sink lower and trade below these round numbers, I do feel that the Bank Nifty bulls will start to feel the heat. In that case, of course, I'll update my social media accounts, and those of you who are connected with me on WhatsApp through our free WhatsApp broadcast list will surely get an update via WhatsApp. Please note, I don't dispense, I don't hand out stock tips. This is pure learning process of why I think the Nifty or the Bank Nifty or any individual sector is likely to feel the heat or feel the joy. And the idea is to teach you how to fish with examples, with charts, with graphs. My contact coordinates at the end of this video will give you my WhatsApp number. Feel free to connect with me, send me a message, send me your email ID with it, and you're on instantly. So in the week before last, this index was at number 3 on the most volatile lists counters. And I told you time and again that an index being so high on the highest volatile list counters is not a good thing. So it fell 6 notches, no less, 6 notches to number 9. And which tells me that the traders have been showing remarkable restraint in trying to buy or sell in large quantities. Do remember the MWPL is lower. So 2 Marshmallow traders are not really showing extreme activity. Last week, I advocated a range between 37,850 on the upside and 34,200 on the downside, which held perfectly well. It's not because of any great calculation on my part, but because the markets were narrower. Do remember the volatility readings itself came down. So next week, I expect an estimated range between 37,850 on the upside and 34,300 on the downside. Although I do feel the range might expand, do remember that the impetus is compressed on both the indices. And when the impetus jumps, volatility will jump through the roof and your ranges might just go haywire. The Bank Nifty done, my friends. I now come to the Nifty 50, the most low impact cost and highest in terms of liquidity on the NSE derivatives space. This index relatively underperformed the Bank Nifty by falling 0.40%. It fell on 3 out of 5 trading sessions. And as the daily chart shows to you, a huge, powerful bearish candle on Friday, the last trading day of the week, engulfed the body of the previous Thursday's candle by a big margin. The price is trading below its 25-day exponential moving average, which is a month-long holding on cost of a bull. The average itself remains downward. So, are the bulls under pressure? I'm willing to bet my money that the bulls are under pressure. Is it pressure that they cannot overcome? Yes, they can overcome it. But are they showing signs, whether it is a 1 Marshmallow trader or a 2 Marshmallow trader? I'm sorry, they're not. They're not showing any signs of great adventurism or writing out big ticket checks and buying in large quantities. So are the bulls appearing tired? I would venture out and say yes, they are. To me, they are appearing tired. Now, if you were to revert to a weekly chart here, a similar inverted hammer candle is appearing on the chart. Although the intra-week high was above its 25-week exponential moving average, which is a 6-month long holding on cost of a bull, but it could not sustain. Now this 25-week exponential moving average is flatlining. It's neither falling nor rising, it's flat. Now, which way will it go? I think if the Nifty was to start closing below the 16,750 odd levels, I think this index will start to fall and the bulls will come under severe amount of strain. What if it doesn't fall? If it doesn't fall at approximately 17,500, 17,600 odd, I expect overhead supply. What is overhead supply? People who've bought at higher levels, they are trapped, the price is down. Now when the price goes up, they start to unload their long positions. Do remember that they've added on cost of carry after rolling over their long positions from the month of April to May. Now they are even more eager to exit because they are panicking. So the overhead supply is likely to be something that is likely to keep the bulls under pressure. So do watch out for the basis, the LWTD of the Nifty, which I put up every day, and the advanced decline ratio, all three of them. Don't worry about it. I always put these metrics up Monday to Thursday on my social media account. Sometimes I do skip out on Fridays because the same is covered in Saturday's video. In the week before last, I saw this index at number 11 on the most volatile counters list, and last week it fell to number 16. Here again, do remember that the impetus fell on a week-on-week basis, which is why you're seeing the volatility readings come down, and it's not necessarily a good sign, because when the impetus jumps, which it might and it will, you're going to see volatility go through the roof. Last week, I advocated a range between 17,800 on the upside and 16,500, which held perfectly well. No credit to me. It's because the indices were narrower. All right, I'll admit that. In the coming week, I expect a range between 17,725 on the upside and 16,450 on the downside. I do advocate trading on very small exposure because volatility might just expand, so threat perception is higher. I follow some metrics used by extremely prominent and popular hedge fund managers. I have a great deal of admiration for hedge funds. The market gods permitting, we might have an in-house hedge fund of our own in a couple of years down the line. So what I follow from these hedge funds is the Traynor ratio and the Jensen's measure. And believe me, both these metrics are not showing a great deal of optimism. As a matter of fact, they are giving me some red flags. So let's play small, keep tight stop losses, and let's be careful out there. Now, friends, before we go any further, I'm going to be releasing a video in the midweek wherein I'm going to show you how you can actually, if you're a very serious intraday trader, improve your profitability by adhering to a particular metric that I call the trade efficiency ratio. And I'm going to show you how you can take home big profits and get out with small losses rather than the other way around. When I started out trading, I used to make small profits either consistently or small profits followed by big losses. So it's like eating like an ant and shitting like an elephant. You need to reverse that if you want to be a serious trader. So do watch this video when it is released. Again, you're going to get an update about this on your WhatsApp. So do stay tuned. Friends, I now come to the most popular segment of this video wherein I give you 5 stocks which are high beta, high impetus, where you take small exposure, wait for large price moves, and 5 stocks which are low beta, low impetus, where you take big exposure, wait for small price moves. Why the difference? Because different traders have different attitudes, aptitudes, and mindsets, so the techniques differ. Now, the high impetus stock list is led by Atul. At number 1, Hero Motocorp. Number 2, number 3, Coromandel. Number 4, TVS Motor. Number 5, Axis Bank. And the low beta, low impetus stock list is led by BSoft at number 1, HDFC Bank number 2. Do remember, after the merger of HDFC with HDFC Bank, both these stocks have become rather quiet. Number 3, Infi. Number 4, HDFC Limited. And number 5, LTTS. Friends, do remember, this hierarchy of low and high beta stocks can change from day to day, hour to hour, because volatility expands and contracts, news flow, trader interest, FII buying and selling, bulk deals, etc., etc. So do stay connected with me on social media, wherein I keep updating all these metrics for you in very simple, easy to understand terms. A high school student can definitely understand what I'm saying. So we can help each other become better traders. Let's get conversations going. Connect with me on social media. And before I wind up this video, a request to subscribe to our YouTube channel. If you haven't already done so, click on the bell icon to receive instant alerts about fresh videos being put about here. Good, bad, or ugly, I welcome your feedback in the comments section. And a request, please help us to reach out to a wider audience who are intelligent people like yourself and who are looking for data and logic-based investment and trading decision-making systems by referring and sharing our videos with your family and friends. Friends, I thank you for your patience and sticking around with me in this video till we meet again in my next. This is Vijay Bambwani signing off for now. Have a very, very profitable week ahead. Bye-bye for now.